Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Rillerzine. Thanks for joining me today. I'm going to be reporting flows for the week ended September 30th, 2015. We saw about $4.8 billion flow out of the conventional fund business, and really it was the fourth week in five that we've seen outflows, but it was due to a lot of things that have been going on. We've been talking about over the last several weeks. Still the hand-wringing goes on about two major things, the Fed and also China. We saw that the China profit margin for their corporate businesses actually went down, and that sent people into another new tizzy. And we actually learned that the PCE, it's a favored indicator, it's a personal consumption expenditure index that the Fed watches, was actually coming in at about 1.3%. Everybody was hoping it'd get closer to 2, and it let us know more about the interest rate increases that would be coming around. That seemed a little bit weak, so it sent people kind of into a tizzy most of the week. However, the last portion of the week, on Tuesday and Wednesday, we saw a rally in both health and biotechnology stocks. Investors were out there scooping it up, so we got a little bit of that back, and the numbers looked a little bit better. But again, we saw about $4.8 billion flow out of the conventional fund business. Let's take a look how that stacked up in the individual macro groups. In the equity groups, we saw about $4.4 billion leave their coffers. Taxable bond funds lost about $6.7 billion. Muni bond funds had a slight outflow, about $390 million, and money market funds was the only positive group, taking in about $6.7 billion, really offsetting the flows that we saw in taxable bonds coming out. So that was kind of the push there. Let's take a focused look on the macro groups to see what happened there as well. Let's turn our attention to equity funds. Equity funds were down 1.15% as far as performance goes for the week. It's the second consecutive week that we've actually seen negative performance out of this group. They lost about $4.4 billion. 6 week and 7, we've seen outflows out of this group. Domestic equity funds saw the biggest share as far as the exodus goes, $3.7 billion. It's the 11th week in 12 that we've seen outflows. Now we get to the non-domestic side, and for the third week in 4, we saw outflows, this time to the tune of about $700 million, $700 million, and just a little bit shy of $1 billion. But again, that's not something we've been seeing. Investors have actually been playing that a little bit close to the best. We did see the outflows this time. How this broke out, though, equity income funds saw the largest outflows, and then we saw large cap funds take the next largest outflows. So equity income saw about $1.5 billion in outflows, and then the large cap saw about $1.2 billion in outflows. Interesting enough, international equity funds, this is something that we've been seeing inflows, even though we've been seeing the domestic side taking in money. They saw about $600 million in outflows, and then when we take a look at emerging markets, they saw about $500 million in outflows. So that added up to be close to that $1.2 billion that we saw. Let's take a look at now what happened on the ETF equity side, and this is a little bit different. Second week in 3, we've actually seen inflows, this time to the tune of $3.5 billion. The big group that took in money was actually one. It was Spider SP 500. SPY took in about $5.7 billion, so that would tell you there was outflows other places. Actually, we also saw with the SP 500, we saw the iShares MSCI Eurozone taking about $639 million. So really what we were seeing was this kind of flight to safety, safe haven plays where people were taking a jump and taking a look at that. At the bottom of this group, though, is kind of the interesting piece where we saw the select healthcare actually lose money. We saw about $900 million, and then financial services, financial select sector, Spider as well, lose money. About $600 million in outflows in that, and that certainly matches what we've seen over the week as far as this kind of exodus out of the high flyers and also health biotechnology, although we did see a late week rally in that. Let's turn our attention now, though, to the fixed income universe. A little bit of change there. 10th consecutive week that we've seen outflows, $6.7 billion. So this is a story that we've been talking about for quite some time. Even though we saw a drop in the interest rates as far as the treasuries go, investors are preparing their portfolios and are making some sort of mass exodus, again to the tune of about $6.7 billion. Second week in a row that we've seen negative performance. It was down 0.31%, so not a lot to write about, but really the only group that took in money was kind of a safe haven play. We saw government mortgages taking about $60 million. That was it. And on the flip side, we saw corporate investment grade debt funds lose about $3.6 billion. That is the largest outflow that we've seen since September 23rd, which was the largest outflow on record. So we've seen the one and two largest outflows since we've been tracking taxable bond fund flows since 1992 happened in this month and in the past 2 weeks. So that's certainly quite a story. If we break this down, though, one more piece that we need to take a look at: high yield funds actually saw a large amount of outflows as well. They saw about $1.2 billion leave their coffers. So it wasn't just the corporate investment grade debt that took it on the chin. Now let's turn our attention to the ETF side of the fixed income universe. We saw about $800 million leave the coffers here. This is the first week in 7 that we've seen outflows out of this group. And as we can see, it was kind of the places that we'd see as far as inflows. It was safe haven plays. The iShares 7 to 10 year bond ETF took in about $259 million. iShares 1 to 3 year Treasury bond took in about $119 million. Not a lot to write back, but if we look at the bottom, very bottom, just like we've seen in some of the other areas, high risk areas took it on the chin. The iShares, iBox, High Yield Corp saw about $414 million. Not a lot to write home about from the ETF side of the universe. Now let's go ahead and take a look at muni bond funds. Muni bond funds actually saw outflows, $390 million. Leave their coffers. If it's the 5th week in 6 that we've seen it, but this is ironic. This is the 2nd week in a row that we've actually seen plus side performance, this time to the tune of 0.46%. That's not a bad return, folks, for a 1 week return for munis. So that was certainly kind of a story there. National munis saw the biggest outflows, about $251 million leave their coffers. It's the 5th week in 6 that we've seen this group suffer net redemptions. Now to the last piece, money market funds. The only positive area that took in money. 2nd consecutive week they took in money, this time to the tune of $6.7 billion. Taxable money market funds saw about $8.7 billion on inflows. How it broke out, institutional investors actually patted away about $10.6 billion versus the retail actually taking out about $1.7 billion. And then if we take a look at the tax-exempt money market funds, they lost about $2 billion out of their coffers due to net redemptions. Well, certainly we all heard that some good ADP numbers that came out during the week, and that certainly was kind of a positive note. But then we heard that the weaker inspected non-farm payrolls occurred, and actually that just peaked up the market. So the market's kind of going on that Schadenfreude concept. Or bad things happen, and that's a good thing. But we'll have to keep an eye on what's going on. Really, what everybody's waiting for is, obviously the employment numbers coming in, but the real number is what are corporate profits going to take a look like. So as we enter our earnings season, which we're starting right now, I think we're going to see some story being told. It could be where we have a very nice rally coming around, or if we have some disappointments, certainly we could see some more big outflows happen. But certainly the next analyst next week will be able to tell you about that. Well, until next time, my name's Tom Rosine, wishing you the best in your wealth planning and creation. And by the way, if you want to take a look and do a deeper dive, you can go to www.lipperusfundflows.com and do a deeper dive on your own. If not, join us next week. Thanks for joining me.